The share price of the company called Hello Group, previously known as MOMO, currently is 10 times lower than at the highest point a couple of years ago. And of course the question is why? Why it happened? It's first of all. And secondly, is it the sign of bankruptcy or further bankruptcy of this company, or is it the best opportunity for investors to buy these particular shares and then enjoy the reward and profit which we can get when the company recovers? Hi, my name is Igor Vasiliev. During this video, we're going to discuss the reasons for this fall. And of course, when we analyze them, we will understand, is it the company which we have to avoid, or it is the company which we have to invest money and enjoy the profit which we're going to receive later. So if you'd like to know about that, stay with us, and at meantime you can click the like button and subscribe to our channel. So first of all, let's talk about the business structure of Hello Group. They have two major kind of platforms. One of the platforms is a social platform similar to Facebook, Instagram, or any other platform, and which allows people to find in a local geographical area people with same interests. Right? So it's a bit different from other platforms in the sense that you can find somebody who loves, let's say, dogs, or who likes jogging, or who likes singing, right? And you can contact them, communicate, you can see them, you can join their group, and then you can meet them face to face or through the social application. Now, this platform also allows you to create different competitions, like, for example, singing competition, karaoke competition, dancing competition, and any other. Now, this platform has two ways to join. You can be a member for free, or you can join certain groups for subscription. So this company, would say, if compared to Facebook, they have two streams of revenue. One is from advertisement, same as Facebook does, but also from subscription, customer subscribing for that. Okay, so they have two ways to make money. The second part of the business is a dating platform which is called Tantan. It was acquired by MOMO at that stage in 2018. Based on analytical research, it's one of the most popular platforms in Asian region. And it allows you to find the person who you want to date with, communicate with this person through the mobile platform which they created. Currently, Hello Group has more than 100 million subscribers. Why is it important to know about it? Because if we understand the size of China and we see that there are more than 1.5 billion people there, we can see that Hello Group has a huge potential for growth. And also, if they decide to move outside of Chinese region, so the potential is huge. So let's have a look how the price fell. So as you can see on this chart, the highest point was in 2018, and we can see it was $54. Current price is $4.46. It means that the company fell $50 in total, which represents 91%. Right? It's a huge drop. And of course, for us, important. Why did it happen, right? And also, we need to understand: is it a sign that the company is going to get into bankruptcy, or is it a very good opportunity for us to buy it? Maybe it's a bargain right now. So let's try to figure out. In order to do that, in order to find companies when I invest, I always look at fundamentals of the business. And initially, I try to find companies through different screenings and different analytical articles, through communications with other investors. And to be honest, if I would say try to find a good opportunity right now, MOMO or Hello Group wouldn't get into my radar. I wouldn't find this company. No way. Because if you look at different platforms, you will see following. So Yahoo Finance. The company is losing money. Earnings per share minus $2.30. Crazy, right? So, of course, forward P ratio is not applicable. Forward P ratio not applicable. Dividends, zero. So definitely, I wouldn't even try to analyze this company, wouldn't waste my time. Now, if you go to CNBC, so we have similar, no dividends, earnings per share negative. Here they put PPE negative. In reality, you cannot calculate like that, but okay, let's. So year to date change minus $48 in percentage terms. So it's crazy, right? So if we go to FinViz, so same story, P ratio not applicable, earnings per share minus $2.40. Of course, the question is, would you invest in a company with such performance? Answer is no, right? But I saw this company before that. So I analyzed this company before that. So, and I liked the company at that stage. So the question is, what happened during the last year that the company's performance is so bad? So I've decided to look deeper, and stay with me if you want to learn what I found. When I looked at the consolidated statement, I'm using Guru Focus for that. Very good platform, and if you want to subscribe, there would be a link below this video in description. So you can click, and 7-day free trial if you join. Now let's have a look. Revenue per share. So we can see revenue per share, so how much company sells their services for one share. So 1.7 cents in 2013, then $1, 67 cents, $2.60, $6.40, $8.90, $10, $10, and you can see that from 2019 to 2020 we have a slight drop around 5%, okay, and then we see the growth in 2021 again. Now trailing 12 months, what it means? It means that last 12 months. So this is until the December 2021. At the moment we have July, so 1 quarter extra here. Okay, so we can see that the sales dropped, but not that huge. What I'm paying attention to more than revenue is the earnings per share. Okay, let's have a look at diluted earnings per share. We're not going to look at all of them, but the interesting thing about, look, the company was making 6 cents. Initially was losing money, same as Facebook, same as LinkedIn, same as other social media platform. So, and after that, the growth was fantastic. Look, from 6 cents to 69 cents. So it's more than 10 times within 1 year. So that's why the share price, you remember on the graphic, it was growing. It's crazy. Then it was $1.5 and then $1.9. That's where was the peak of the price of the share. At that time, at 2018, the share price was $54, okay, at that stage. Now then we can see in 2019 we have still slight growth, but more like flat, and then we have a drop in 2020. Now the management says that it's due to coronavirus, in some issues about that, because as I explained, their social media platforms based on the geographical location and the interest. So a lot of time people interact in the social media, but after that they meet face to face, and they go, for example, if it is jogging club or fitness club or dog lovers club, they go and meet physically, right? But because of COVID and restrictions which were in China, they couldn't do that. So the importance of this platform, probably people didn't stay as much, and as a result the company didn't create as much money. Now things changed, right? So yes, there are sometimes lockdowns in China again, but most of the time they can freely operate and freely walk around. So personally, I might see here the improvements and popularity of this platform again. But then look at the last year. That's huge. Like the company was making $1.4 in 2020, and then huge drop to 2026 cents in 2021. Huge drop. Why? If we look quarterly, so we see that actually the company was making 32 cents, 33 cents, like nearly 30 cents, and then a huge drop to $3.37, and then again 22 cents profit. The question is why? When I see something like that, when I see not consistent profitability or loss, so it's always question why. Because what the heck has happened during that particular quarter that brought the company to such a loss? And very often, I'll tell you, it just play with numbers. Okay, I am going to show you that I was right in this particular case again. What I do when I see something like that, I try to break down the income statements, and that's what we're going to do right now. So look at this. Revenue during that quarter was about the same as previous quarter, so 577 million, slightly less than previous quarter, but more than previous 2 quarters, right? And even the last quarter after that, it was much lower, but still remember that it was profitable. So then we look at the gross profit. So 232 million. So pretty in the same level as before. After that, if we go for operating income after all these expenses, right, we can see that it was $60 million compared to 74 million here, 107 here, 71. So slightly less, not slightly, like nearly 20% less, and here nearly 40% less, but still profit, right? And it's more than the last quarter. And remember that last quarter for the company was profitable. So the question is why? Why is still the final net income is negative? Because we can see here other income expense, $690 million. So the company had a loss, something other from the normal activities of the business, 690 million. What is it? And we can see that it's one time of previously company never had something like that. And here it is, we have this. So usually what I do after that, I look at the balance sheet, because very often that it's what company does, they write off certain assets. Okay, for example, it can be inventory. So they have some stocks which they cannot sell. It just stuck in the warehouses, and they decided to write it off. It's one way to do that. Second, the most popular, it's writing off goodwill. Okay, and that's exactly what happened here. Look at this, intangible assets. So who doesn't know what it is? I'll explain. Now, intangible assets, it's assets which you cannot touch. Goodwill is when you buy another company, and remember that in 2018 they bought this dating platform, and when you pay for something, you pay for assets, and then you pay some extra for the brand name, right? So that's what they overpaid. So they paid extra for, if you take like tables, computers, chairs, machinery, whatever, right? So the assets, tangible assets, and then they something paid extra. So they need to put it on books as well, and they put it as a goodwill. And we can see they were writing it off slightly. 776, 749, 730, so slightly writing off intangible assets. But during that quarter, particular quarter, they decided to write it off completely. Look at this. They had 714 millions of intangible assets, and by the end of that particular quarter, we have only 4 million. So they wrote off 710 million of intangible assets. So they wrote off goodwill and practically all the rest of intangible assets as well. So guys, why it is important to know? Because when you're writing off something like that, you're not losing money. The money is still on your account. So it's like paper loss, okay, paper expense, because you just write it off. It doesn't really matter if it is on your books or out of your books, right? Financially and from operational activities for the company, it doesn't really make any difference. But when you show it to the government, to the taxman, and you show this expense, you save a lot of money on taxes. I'm not sure how much they pay in percentage terms on taxes. I didn't look at this point, but would say if they pay 30%, right? So by writing off $714 million, they saved practically $210 million in taxes. So they didn't pay. So the cash flow was higher. It's not like a profit count as a profit, but it comes as a cash flow. So they don't have to pay to the government as a tax. So it is actually the good thing when companies write off goodwill. But when investors, they see it, and if they don't understand that, for them it's really, really scary, because from $1.4 in profit, annual profit, the company goes to negative $2.4 in loss. So it's definitely scary. And if we come back to the first slide, financial statements, we can see that here book value per share. So it's all assets divided by amount of shares, and we can see that book value, so including tangible and intangible assets, was $11.40, right, in September 21 quarter, and tangible book value was $7.8. So the difference between tangible and intangible assets was $3.60. So we can assume that about $3.60 was the value of intangible assets. And look at this quarter, they're exactly the same, right? So $8.3 and $8.3, practically the same. So it means that we wrote off about $3.6 of intangible assets. So if we take and add them back, so I would say if we take off this loss, expense, right, and add them back, so we can see that the loss was $3.3 and we add back $3.6. So we actually get about 22 to 23 cents in profit. So if we weren't writing off that goodwill. Basically, if we calculate profit after that, after this type of changes, so we can see that the company was making 33 cents, 30 cents, would say 23 cents and 22 cents. So together it's 45 cents, and here roughly 60 cents. So it's about $1, like 5-10 cents, something like that. So that was the profit for the company during last 12 months. The next question which we have to ask, is this company expensive now or not? So if we take this write-off and we calculate the profit, we can see that the total profit roughly $1.05 for the last 12 months, and the current share price is $4.60. So if you divide $4.60 by $1.10, so you get about $4.4. Right? So it means that P ratio of 4.4. So if you buy the whole company and the company keeps making money for the next 4 years, you're going to get all the money back, right, from this separation. So the question is it expensive or cheap? In order to do that, we need to compare it with historical evaluation of this particular business and also with competitors. Now, if we compare with competitors like Facebook generally P ratio was over 20. Currently is around 15, right? So sometimes it goes up, sometimes down, but roughly that time. Now with MOMO it's 4, right? If we look at the P ratio for the last few years, we can see in 2015 it was crazy to 167, right? Then it's dropped to 26, then 16, 12, 17. So roughly like in the average, I would say 15. In 2020 it was 9. The price already dropped. Now let's assume that investors eventually see this company. So when like another 2 quarters pass, and when start people research it and do screening, and they will see that company is profitable during the last year, so it will pop out on a radar, right? And they will see it. So, and if people investors pay 10 times still cheap of their earnings, and the company is making, let's say, $1.10, so it means $1.10 multiplied by 10, it has to be around $11. So if they pay 15 times of their earnings, so it means that the company has to jump close to $15.50, so which 300% return from the current price. Now, if the company on the top of that start making more money, so if the influence of lockdowns in China disappears, right, and people start using this platform again more, and of course advertisers jump there and start paying more for advertisement, and the company start growing even with a slower rate. So we might see that the share price of this particular business might go to $20 easily, right? I'm not telling that it has to jump back to $50, but at least a range from $10 to $20 is pretty acceptable. Of course, I might be wrong because it's my personal opinion, and put in comments your own opinion. What do you think about this company? Do you agree with my research, or maybe something missed and you can point it out? I'd love to hear from you guys, so put it in comments. And while you're doing this, I'm going to show you another ratio which called price to book ratio. Remember that book value is the total assets divided by amount of shares. So it means that if the company, for example, decided to close it down, its operation right now, and after that they sell their assets, they have to get whatever they have intangible assets, like basically, because even if they buy a computer, they depreciate it, so it's on books, it's worth less. Of course, during this, a lot of legal expense, etc. So it's never happens exactly the same amount. Sometimes it can be more, sometimes it can be less, but in any way, so we can roughly expect that we're going to get that. Right? Remember, we had $8 of book value per share, and the share price is $4.70. So if the company goes into liquidations right now, so and we sell all the assets they have, we actually can get $8, not $4, which cost of the share. It's like really funny situation. If you decide to buy apartment, say you pay $500,000 for this apartment, but when you move to this apartment, you will find that they have furniture there for, let's say, $600,000 or $700,000, so which you can sell it and you better off, right, than you paid for your apartment. And that's what we can see here, because previously company was selling 5 times of their book, 6 times, 4 times, 3 times, and currently it's half of the book value. Now Warren Buffett buys when the book value is roughly lower than 2.5, so he's getting really interested in this particular company. So here we can see that the company is in a share price is half of the price of the assets. Same situation with the price to free cash flow. So we can see the company used to be priced 73 times more than their cash inflow. Currently, it's 6 times. So let's summarize what we just discussed. So first of all, the company was growing pretty fast from 2013 to 2018, and that's the main reason why people were happy to pay such huge premium for the share price. So when it's reached the topmost point at $54 and it stopped growing, investors lost the interest. You know, those high growth investors, and the share price started to adjust to the valuation which people would put on not growing companies. But after that, it's also start losing the momentum in profitability, and the margins start decreasing, because we could see that sales level stayed exactly the same as it was. Even it keeps growing slowly, but the margin starts squeezing. So that's why we can see that the profit dropped from $1.9 to $1.4 in 2020. And on top of that, in 2021, we can see this manipulation with the writing off Goodwills. And all this brought to the collapse of the share price in this particular company. Now, we know that, we see that operational income is still there, the company is still making money, and it's an environment which has a huge potential for growth. And of course, if you're deciding, should I buy this company or shouldn't I buy it, you have to evaluate your own circumstances. Remember that this video is not an advice. It's just the way to explain how some reports can be made that can scare the people. Now remember that the opportunity exists when everyone is selling, when people are scared and the share price collapse. That's very often represent very, very good opportunities to buy, because we saw that if P ratio normalized like even to 10, so we make 100% in profit. If it goes to P ratio 15, we make twice as much. Remember, every time we have to understand the reason of the fall, and we have to understand, is it permanent or is it temporary? Is it solvable or not solvable? And if it is temporary and solvable, it represents a good opportunity for investment. Ladies and gentlemen, if you'd like me to analyze another company, put in comments what kind of company you would like me to analyze, and I'll do that. And also put a like if you like this video, subscribe to our channel, and share this video with people who you think might benefit out of it. All the best, and see you next time.